stop what you are doing right now and listen. Because what I'm about to show you is the difference between watching generational wealth happen to someone else and positioning yourself inside it before the door closes. I know what the silence sounds like in a bull market. I know the feeling that settles in when the forums go quiet, when the comment sections drain out, when the people who were screaming silver to the moon 3 weeks ago have gone completely dark. The silence feels like a verdict, like the rally is over, like the party moved on without telling anyone who is still holding metal. That silence is the most dangerous trap in precious metals history, because here is what almost nobody is telling you. The silence is not the market dying. The silence is the market loading. Gold is at 5,040. Silver is at $77.81. And right now, 5 completely separate signals are converging simultaneously, each one independently significant. Together, they form the clearest institutional accumulation blueprint this market has assembled in years. Stay with me, because what happens in the next 30 days will determine who positioned correctly and who spent the entire bull market sitting on the sidelines doubting. Let me show you what is actually happening beneath the silence, because the trading volume data tells a story most people are completely missing. On January 30th, 2026, silver crashed from $121 to $78 in a single session, the worst single-day collapse in 46 years. COMEX volume that day was 317 to 240 contracts, the highest single-session volume in the entire data set. That was panic. That was tourists getting liquidated at the worst possible price. Then something started happening that separates every bull market from every bear market in history. The volume started dying. February 6th, 105,000 contracts. February 12th, 91,000 contracts. Recent sessions, 28,000 contracts, a 91% contraction from the panic peak. Think about what that means. The sellers came back 3 times after the January 30th crash, each time with less ammunition, each time achieving a worse result. And now the volume is running at 9% of the panic peak. The sellers are not regrouping, they are finishing. When volume collapses like this during a consolidation, it has a name: accumulation. The tourists panicked out at $121 and sold at $78. The professionals are buying at $77 while the forums are silent and the doubters feel vindicated. Now let me show you the 5 signals that confirm the loading phase is almost over. Signal 1, the APMEX normalization announcement. Ken Lewis, the CEO of APMEX, sent multiple letters to customers throughout January and early February. On January 14th, he instituted a $10,000 minimum order just to slow down demand. APMEX was 4 days behind on shipping. Customer service headcount increased by 25%. They reduced their product selection to 31 core silver products and could only keep 21 of them in stock at any given time. On January 18th, the minimum dropped to $500, but he said their mint output was still impacted by approximately 50%. Saturday, January 17th, was the 3rd busiest Saturday in APMEX's history, 4 times a normal Saturday. By mid-February, shipping times returned to normal. The backlog cleared. The CEO thanked customers for their patience during what he called historical volume. Now here's what the forums got wrong. They interpreted the normalization as demand dying, the rally over. That interpretation is backwards in every direction. When APMEX is drowning in 8-week shipping delays and jammed phone lines, that is not a healthy market. That is a panicked one. The 317,000 contract volume on January 30th was the tourist wave arriving at maximum emotion. People who had never purchased a single ounce in their lives calling to buy 20 because they watched a video. That is the emotional buyer class, and they represent the highest risk entry point in any bull run. These are the same people now sitting on 36% paper losses and quietly considering the exit. When the normalization announcement arrives, it does not mean demand is gone. It means the amateur wave has receded, the tourists have gone home, and the moment they leave, the professionals enter. If you are an institution managing a 9-figure precious metals allocation, you cannot build a position efficiently while retail panic is inflating premiums $15 over spot. You wait for the shipping times to normalize. You wait for the phone lines to clear. You wait for the moment you can accumulate hundreds of thousands of ounces without driving your own cost basis higher. The APMEX normalization letter is the opening bell of that window. The volume confirms the transition. 317,000 contracts on January 30th, 28,000 contracts in recent sessions. A 91% contraction. The tourists are gone. The professionals are operating in the space they left behind. Signal 2, JPMorgan's $6,300 gold target and the institutional price architecture surrounding it. On February 2nd, 2026, JPMorgan published a research note that reset their gold price target to $6,300 per ounce by the end of 2026. That is a 25% increase from current levels, not in 5 years, not in a decade. by the end of this year. The note said demand from central banks and investors should keep pushing prices higher. They forecast central bank gold purchases at 800 tons in 2026, citing an ongoing unexhausted trend of reserve diversification. And here is the language that matters most. Even with the recent near-term volatility, we remain firmly bullishly convicted in gold over the medium term. They published that statement on February 2nd, 2 days after the January 30th crash, after gold dropped 9.8% in a single day. And their response was not to lower the target. It was to raise it to $6,300. Now put that target in context with the broader institutional price architecture. Goldman Sachs just raised their end of 2026 gold forecast to $5,400 and explicitly labeled it a forecast with significant upside risk. Translate that language plainly. Their published number is deliberately conservative. They are hedging their own forecast because they do not want to be on record with the number they actually believe when this move completes. Deutsche Bank reiterated their gold price forecast of $6,000 per ounce in 2026. UBS raised their target to $6,200 by September 2026. Wells Fargo Investment Institute lifted their year-end 2026 gold target to $6,100 to $6,300. The consensus among bullish banks centers around $6,000 to $6,300 by year-end. These are the largest capital allocators on Earth publishing institutional price targets during the so-called quiet period, while volume runs at 9% of its January 30th peak, while forums are silent, while retail investors are doubting. The institutions have already told you where they believe this resolves, and here is the detail most people are missing. JPMorgan also published an upside scenario in the same research note. If global portfolio allocations to gold normalize by just half a percentage point, from below 1% to 1.5%, their model shows gold reaching $8,000 to $8,500 per ounce. Not if allocations double, not if allocations triple. If they go up by 0.5%, that is how underallocated institutional capital currently is to precious metals. And that is how explosive the move becomes when that reallocation starts. Signal 3, the Wall Street Journal and Bank of America double contrarian signal. On September 20th, 2022, the Wall Street Journal declared that gold had lost its safe haven status. Gold was trading at approximately $1,600 that day. From that precise date, it moved to $5,100, a 213% gain from the exact moment the publication called the trade dead. Now, in the same news cycle, two things have happened simultaneously. The Wall Street Journal is running negative gold coverage again, and Bank of America has called gold and silver bubbly. Two establishment voices, one news cycle, same direction. This is not independent analysis, it is the same documented playbook. The banks are short. Retail sentiment needs to break downward so positions can be covered at lower prices. And the media apparatus produces the corresponding narrative. Bank of America is calling gold bubbly at $5,040. On the same day, JPMorgan has $6,300 as a base case in writing. They know exactly what JPMorgan's models say. They are calling it a bubble anyway. That is a service to their short book, not an analytical conclusion. The 213% track record from September 2022 is the documented outcome of ignoring this signal. Two establishment voices firing simultaneously in the same direction is not twice as alarming. It is twice as bullish, because here is what that signal actually tells you. The establishment needs retail to sell, and they need it badly. When Bank of America calls something bubbly, they are not warning you. They are positioning themselves. Signal 4, Tether's gold position and what it tells you about dollar confidence at the institutional level. Tether is the issuer of USDT, the largest stablecoin in the cryptocurrency market. Their entire operational mandate is to hold US dollars in reserve for every token in circulation. According to their most recent public disclosures, Tether now holds 148 tons of gold, approximately 4.76 million troy ounces. At current prices, that position is worth approximately $24 billion. A stablecoin company whose job is to be the safe dollar-backed layer of the digital asset ecosystem has assembled a gold position larger than the sovereign reserves of Australia, South Africa, and Saudi Arabia combined. Let that land. Tether's core obligation is stability. They are supposed to be holding dollars. They are converting those dollar reserves by the tens of billions into physical gold, because the people running that organization have reached an irreversible conclusion. The dollar in sufficient concentration is not a safe enough reserve asset. If the entity whose entire purpose is to be a dollar proxy is fleeing into gold, that is not a marginal signal. That is institutional capital at the highest level making a structural declaration about the future purchasing power of fiat currency. Now connect that to what is happening on the physical supply side. COMEX currently holds approximately 82 million ounces of registered silver, 75% lower than 2020 levels. In December alone, across 4 trading days, 47 million ounces were claimed for physical delivery. That is 57% of the entire registered inventory consumed in less than 1 week. The silver market has run a documented supply deficit every single year since 2021, with a cumulative shortfall reaching approximately 800 million ounces, essentially 1 full year of global mine production simply missing from the system and never replaced. Industrial buyers, who historically maintained 3 to 4 months of inventory buffer, now hold approximately 1 month. The margin of safety is gone. Tether's move and the COMEX data are the same story from 2 directions. Institutional capital racing toward physical assets whose supply cannot expand to meet demand at current prices. The February 6th intraday probe to 63.90, which reversed $13 within the same session on physical buying, proved exactly where the floor sits, and proved it is unmovable. Signal 5. Scotiabank's confession and the central bank buying data that backs it up. Scotiabank just published a precious metals research note whose central conclusion was 5 words. The bull cycle is not over. They cited spiraling fiscal deficits, a United States national debt exceeding $38.56 trillion with annual interest payments above $1 trillion, weaponized tariff policy, eroding dollar reserve trust, and continued monetary expansion, diluting purchasing power across every dollar-denominated savings account in existence. To understand the full scale of what Scotiabank is describing, consider the central bank response that has already occurred. When Western governments froze $300 billion of Russian reserves in February 2022, every emerging market central bank reached the same simultaneous conclusion. Dollar reserves held in concentration are not sovereign. They can be canceled. The result was the largest structural shift in reserve management behavior in modern history. Central bank gold purchases quintupled following that event. 4 consecutive years of global central banks buying more than 1,000 tons of gold per year. Goldman Sachs described it explicitly as a structural shift in reserve management behavior. Not a trend, not a cycle, but a permanent change in how sovereign institutions manage their balance sheets. 95% of central banks now expect total global gold holdings to increase. 43% plan to actively add to their own reserves in the near term. And despite the largest gold rally in 50 years, the average allocation across all global investment portfolios remains below 1%. JPMorgan ran the math on that number. A 0.5 percentage point normalization in global portfolio allocation would independently push gold to $6,000 per ounce. Not a full percent, 0.5%. When a mainstream bank publishes language as direct as Scotiabank's 5-word conclusion, it is not analysis. It is a confession that the macro environment has moved beyond the point where institutional denial is credible. Now let me connect all 5 of these signals for you, because separately they are interesting. Together they tell you everything. The APMEX email confirms the tourist phase has ended. The 91% volume contraction confirms the professionals are now accumulating in the space the tourists left behind. JPMorgan's $6,300 target, with an upside scenario of $8,000 to $8,500, confirms where institutional capital believes this reprices to. Goldman's $5,400 with significant upside risk. Deutsche Bank's $6,000, UBS's $6,200, Wells Fargo's $6,100 to $6,300. The institutional consensus is clear, and it is not $5,040, it is $6,000 plus. The Wall Street Journal and Bank of America double contrarian signal confirms the establishment is running the same suppression playbook that preceded a 213% move in 2022. The COMEX data and Tether's position confirm that structural demand is outrunning physical supply, with 57% of registered inventory claimed in 4 December trading days, and an 800 million ounce cumulative deficit that continues to grow. And Scotiabank's 5-word confession, backed by 4 consecutive years of central bank gold, buying above 1,000 tons, and a global portfolio allocation below 1%, confirms the macro environment has passed the point of institutional deniability. 5 signals, 1 structure, 0 ambiguity. Let me describe the sentiment landscape right now, because it is telling you something specific and time-sensitive. Investors who purchased silver near the all-time high of 121 towards 79 are sitting on paper losses of up to 36% from that peak. Some are frightened, some are quietly questioning whether the thesis was wrong. Forum activity has collapsed. Conviction threads have given way to doubt threads asking whether the January run was a false breakout. Meanwhile, investors who stayed out of the January rally feel vindicated, disciplined, correct, and now waiting for an even lower price before they enter. This is the precise psychological configuration of a market bottom, not a top. At a genuine top, sentiment is unanimous and loud. Everyone has a price target. Everyone is adding size. At a genuine bottom, the bulls are exhausted and doubtful. and the sideline skeptics feel justified. The current mixture, quiet fear on one side and quiet smugness on the other, is the most reliable structural signal of an approaching reversal in market analysis. It is also the exact environment that makes professional accumulation possible. The boredom is not a sign that the thesis failed. The boredom is the thesis executing correctly. Now add one more data point to that sentiment picture. Bitcoin has recorded 7 consecutive monthly losses measured in gold ounces, not in dollar terms. In gold ounces, 7 consecutive months without precedent in Bitcoin's entire history. Not in 2018, not in 2020, not in any prior bear market. The asset that was supposed to render physical metal obsolete has spent 7 straight months transferring purchasing power to the people who held gold instead. The tourists left precious metals for the crypto casino. The crypto casino is delivering a historically unprecedented losing streak against the very asset they abandoned. When that realization reaches retail investors at scale, the redirected capital will not find the entry conditions that exist right now. The sentiment is bored. The alternative is failing. That is not a coincidence. That is the fuel accumulating beneath the surface. During the January rally, the physical market infrastructure was overwhelmed. 8-week shipping delays, premiums $15 over spot, dealers selling out within hours of restocking. 317,000 contracts on January 30th. That was not healthy demand. That was tourist panic. People who bought at $121 because every headline confirmed the move, and who are now sitting on 36% paper losses, quietly considering whether to cut and leave. The smart money did not panic when the price pulled from $121 to $78. They did not ask whether the thesis was broken, because the thesis is built on data that has not changed. COMEX is still at 82 million ounces, 75% depleted from 2020. The 800 million ounce cumulative deficit is still growing. Tether is still accumulating at a scale that places them among the top 30 gold holders on Earth. JPMorgan still has $6,300 as their base case with an upside scenario of $8,000 to $8,500 if allocations rise by just 0.5%. 95% of central banks still expect global gold holdings to increase. The average global portfolio allocation is still below 1%. None of the structural factors that drove silver to $100 to $21 have reversed. The only thing that changed is the paper price. And a lower paper price on a structurally undervalued asset is not a sell signal. It is an accumulation signal. The professionals know this. They're not posting about it. They're not sharing their thesis. They are buying at 28,000 contracts of daily volume while the forums are quiet and the tourists have moved on. The transfer of ownership from weak hands to strong hands is visible in the volume data. 317,000 contracts of tourist panic on January 30th. 28,570 contracts of quiet, disciplined professional accumulation now. The transition is underway. Now let me tell you what I think happens in the next 30 to 60 days. The consolidation continues for another few weeks. Maybe silver tests $74 one more time. Maybe it holds at $77. Either way, the physical floor has been proven. When the February 6th intraday low of $63.90 reversed $13 within a single session, that was the physical market telling you the absolute bottom. Retail continues to doubt. Forums stay quiet. The doubters continue to wait for lower prices that never come. And then something breaks. Could be China reopening after Lunar New Year and rushing to buy at a discount. Could be a March delivery squeeze at COMEX. Could be a geopolitical event. Could be a single hedge fund deciding to take delivery on 10 million ounces. When that catalyst arrives, the move will not be gradual. It will gap. Because the sellers have already exhausted themselves at 9% of the panic peak volume. And the physical bid is waiting. Silver will reclaim $90 within a week of the catalyst. Then $100. Then the all-time high at $121. And every single person who spent the quiet period doubting will be chasing at $100 asking if it is too late. The people who accumulated at $7,700 during the silence will already be positioned for the next leg to $150, $175, $200. This is how every bull market works. The explosive moves happen when nobody's watching. The consolidations bore people into leaving. And the professionals accumulate during the silence while retail is convinced the rally is over. Here is my final assessment. The APMEX normalization confirmed the close of the tourist phase. The 91% volume contraction documented it. JPMorgan's $6,300 base case with Goldman's $5,400 significant upside risk, with Deutsche Bank's $6,000, with UBS's $6,200, with Wells Fargo's $6,100 to $6,300, tells you where institutional capital believes this goes. The Wall Street Journal and Bank of America double contrarian signal, which produced a 213% gain in 2022, is firing again. Tether's 148-ton gold position and COMEX's 82 million ounce inventory, 75% depleted from 2020, with 57% claimed in 4 December days, confirms physical demand is outrunning supply. Scotiabank's 5-word confession, backed by 4 years of 1,000-ton-plus central bank buying, confirms the macro environment supports the thesis. 5 signals. 1 structure, 0 ambiguity. Gold is at $5,040. Silver is at $77.81. The volume is 9% of the panic peak. The loading phase is ending. When it finishes, it will not announce itself. The price will gap. The volume will expand. And the entry you are standing in front of right now will be a memory. Subscribe to this channel. Every signal, every data point, every development that matters for precious metals will be here before the crowd catches up. The quiet period is in its final stage. The 5 signals have confirmed it. The professionals are loading.